Hello, Mike Brown here, and we're going to be talking a little bit about the summary of significant accounting policies and other disclosure requirements. So really we're focusing here on the footnotes. So let's start with what US GAAP says about this. It does require a description of all significant accounting policies to be provided. Preferably, this is either going to be note number 1 or at worst note number 2. I've seen it both ways. Sometimes companies will use the first footnote as a kind of general description, and then they'll go into the significant accounting policies in number 2. But regardless, the idea is that it's fairly obvious and easy to find for the readers of the financial statements. It should walk through the measurement basis that was used in the financial statements, as well as key accounting principles and methods used during the period, and that can be on a wide range of issues such as how generally they depreciate or amortize, how they cost or price their inventory, general information about use of estimates, and so on. Now, to make sure this is clear, with this statement I'm saying these are items that are not included in the significant accounting policies footnote. I am not saying they are not in the notes. In fact, that's quite where you will find a lot of these things are in specific notes that would follow later in the footnotes. For example, if you are providing details as to the composition and amounts of a balance sheet item, yep, that's going to be in the footnotes, but that would not be appropriate for the significant accounting policies note. Details regarding a change in accounting principle would not be. Details about maturity dates and amounts of payoffs for debt, computation of amounts for depreciation. As we just mentioned, the policy footnote would simply say, here's how we depreciate. Further on, you'd expect a fixed asset footnote to detail the computation of that depreciation for the year. And that's the key difference. Ultimately, what is included under US GAAP is supposed to follow a simple idea. Will it be useful to decision makers? And so the body of the footnotes beyond the significant accounting policies would be any other information that is in fact relevant to those decision makers. Now, there's some examples I can provide you here, and it's by no means an exhaustive list. A lot of times it's going to give you material information and details about specific assets or specific liabilities. It will provide information about the nature of changes in stockholders' equity. It may give disclosures required for certain classifications of marketable securities. It likely will have a footnote if there's significant fair value estimates. Again, it's anything that would be relevant to the decision makers in evaluating the financial statements. Additionally, information about contingencies, both contingent losses and highly probable contingent gains, commitments, contractual obligations. There will be footnotes about pension plans. If we're talking a public company, segment disclosures, dealing with subsequent events, as well as changing accounting principles, or simply implementing a new accounting standard. All would be included as part of the body of the footnotes because they have that informational and decision-making relevance. Another broad requirement US GAAP lays out is to disclose risk and uncertainty, right? Basically, kind of a peek behind the curtain as to what management is worried about, because again, that could be very relevant to a decision maker. So describing risks and uncertainties around major operations, major products, major geographic distributions, whatever the case may be. If they run more than one business, what's the relative importance of one business versus another? Certainly the use of accounting estimates carries with it certain risk and uncertainty by its very nature, so disclosures about that are relevant. All right, in addition to estimates in general under the broad umbrella of disclosing risks and uncertainties, there's also a requirement for certain significant estimates. You can see a listing of some of those here, from deferred tax asset valuation allowances to litigation-related obligations and a number of others. But here's the kind of threshold. What would put something on this list? Here's when it is reasonably possible the estimate will materially change in the near term, then an estimate and the effect of that change should be disclosed. So perhaps it's because you think that the lawsuit's going to be resolved and it's going to change that estimate in the near term. Whatever the case may be, if that's true, then you should provide that information. All right, another area of interest to the reader is, I call it the eggs in one basket scenario, right? Has the company placed so much risk in one area that presents a risk that, moreover, could be offset if they diversified? So when does this have to be disclosed? Well, there's three main requirements. If these criteria are met, then that concentration of risk should be disclosed. First, that concentration has to be in play as of the balance sheet date. That makes sense. Second, it basically has opened up vulnerability to a severe adverse impact. So basically saying, if this risk that we can perceive were to come to life, it would be really bad. It's really going to adversely affect the entity. And we believe it's reasonably possible that actually is going to happen. So that's the vulnerability to a concentration of risk. That also must be disclosed in the footnotes. So what might be an example of such a concentration? Well, it could be you're highly dependent upon a specific customer, supplier, lender, contributor, you name it. So think of it as anything in the supply chain, for example. I think a lot of companies have learned where those vulnerabilities exist, even if they weren't aware of them previously. If you generate most or a significant amount of revenue from a particular product or service or type of event, if there's a concentration in certain supplies of materials on hand, or it could even be a market or geographic concentration, any of those could be then put through the ringer of those specific criteria and ultimately need to be disclosed as a vulnerability to a concentration of risk.